So the tides come in and out, but the sea levels are rising. And over time, that translates into a way to manage the inflation, but also to raise the capital, which means you have to pay higher rates.
Today we have Chamath on the All In podcast, expressing his concerns about the current state of the economy and why financial markets are in for a rude awakening. Following an extensive legal battle, Ripple, the company responsible for the XRP token, has achieved a significant victory in the case brought against it by the US Securities and Exchange Commission. In the 2020 civil lawsuit, the SEC accused Ripple of violating federal securities laws by selling the XRP cryptocurrency to retail consumers. However, a US Southern District Court in New York ruled differently on Thursday, stating that certain sales and distributions of XRP tokens by Ripple did not qualify as investment contracts, and thus did not violate securities laws. The ruling sparked optimism among cryptocurrency investors. They interpreted the decision as an indication that token sales on exchanges are not classified as investment contracts within the cryptocurrency industry. The past few months have been tumultuous, particularly due to US regulators' insistence on categorizing almost all cryptocurrency tokens, except for Bitcoin, as unregistered securities. Let's get right into the latest interview with Chamath, as he gives his market prediction for 2023 and what the economy can expect in the last half of the year. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
Just think about how amazing the United States is, that the government, agencies, the administration in power can come after corporations. And then we have a court system that can adjudicate and make decisions that follow the rule of law. I know we're going to talk about Lina Khan and her agency's efforts at litigation, but I'm really encouraged at the fact that the court system in the United States doesn't just kowtow to whatever administration is in power at that moment, that they do adjudicate by the law and ultimately provide greater clarity for business, for individuals to operate going forward. That there is a better sense now for the market. There's a better sense now for individuals.
Has this trend changed? I thought America always did that.
Yeah, I think it's great. I think it's, look, because you obviously have a very zealous administration and a very zealous agency leader who is testing the boundaries. And Lina Khan's agency is pushing the limits on what constitutes antitrust. And in the effort to try and push those boundaries, there is a pushback from the courts.
No, but in crypto, it's been Gensler and the SEC.
And it's been Gensler and the SEC. I'm sorry, I'm talking, but both agencies, right?
The big news this week is inflation has eased to 3% in June. So the Fed's increases have worked. And I guess the question now is, are we going to have a sustained high interest rate, or is it going to get cut slowly?
I think Larry said publicly that he thinks that rates are going to need to be higher for longer than what the market is currently showing. We talked last week with Brad, obviously, about what the market is showing rates to be, and he's assuming some rate cuts will start to happen in December, and that's really what the market is saying is going to happen. And Brad's point was the market knows better than the forecasters. But Larry Summers has publicly shared that he thinks that is actually not correct. And, again, diversity of views is important to understand, that there are structural things that are happening in the world right now, including a decoupling from China, which is inflationary because, China provides cheap goods and cheap manufacturing for a lot of industries, and many of those industries sell to consumers. So ultimately, those prices are going to show up in consumer costs. There's an increase in energy transition expenditure and security globally. And Summers has pointed out that those are not free. They have to be funded. And obviously, taking on more funding means you're going to have to pay higher interest rates for investors to provide that capital to do that funding.
The more important thing from that, JCal, is, so what do we do about it? And I think the most important point of view that I'm trying to get to is, where do I think the equity market is going to go? And all roads, at least right now, look like the market is getting set to go materially higher. And the reason isn't whether, terminal rates are at 2% or 3% or 3.5%. I don't think that matters that much. What matters more are the trillions of dollars that are sitting on the sideline or in other defensive assets that need to then pivot around and get put back into growth assets once you know that the worst is behind us. And I think that's what a market always looks for before real sentiment changes. And what's important to note is that by the time most people figure out that the sentiment has changed, it's already actually too late. And so I think right now in the next sort of like 12 to 18 months is really when the bottom is put into the market. It's before the Fed starts cutting. It's when rates are still going to be relatively high, but the really astute sharp in this market will get ahead of it, and they will start to buy what they think will be an eventual rally. So I think that Larry is right. I think that I still believe what I've said for a while, which is rates will be higher for longer. But what I didn't believe before was that the market was set to go up. I think we did a great job. I think literally that when I made that comment November of 21 about starting to sell, it was the absolute top of the market.
Yeah, you nailed that one.
Nailed it. And I think my commentary now is that we're putting in the bottom. And I think the market is set to go materially higher, even if rates are persistently higher for a while.
I don't think it's going to be a mania, but I do think that the market is ripping today because the market is basically pricing in the idea of a soft landing along with inflation being tamed. So you had a positive CPI report at 3%. You had a hot jobs report a week or two ago. And there's an interesting article in the Wall Street Journal today talking about the odds of a soft landing improving. And they have some data for that. I don't particularly agree with the subheadline. They're trying to...
Latest data suggests a lot of past inflation was transitory. That seems...
Yeah, that I think is being too charitable to the Fed, because when they use the word transitory, they were using it as an excuse not to raise interest rates. And we just had the fastest rate tightening cycle ever over the past year. That's the reason why inflation has gone down. It was not transitory until they jacked up interest rates from 0 to 5%. So the Wall Street Journal, I think, is doing a little covering for the Fed there. But nonetheless, I think everybody is pleasantly surprised that A, CPI is now down to 3%, and B, you have not had a significant cooling of the jobs market. So certainly the odds now of a soft landing have gone up.
The Fed and the market are all acknowledging and reacting to these acute conditions that are being resolved from coming out of the COVID stimulation. But there are in place, as the comments have been made, increased spending to NATO because of global security concerns, increased defense spending globally. The current projection from the CBO showing what defense spending is going to be as a percentage of GDP or a percentage of government spending, there are some folks, as you guys all know well, who you would speak to in DC, who think that those numbers are BS because we're going to increase defense spending, not cut it, because of global security concerns, particularly as we decouple from China. And all of the energy transition stuff, the IRA, the CHIPS Act, which is a security thing, these are all stimulatory. So the tides come in and out, but the sea levels are rising. And over time, that translates into a way to manage the inflation, but also to raise the capital, which means you have to pay higher rates. And this is in the EU and the US that it seems this is going to be the case.
Former SEC official Christian Schultz expresses that the Ripple decision should be viewed as a victory for the crypto industry. He believes that XRP is not a security, and the transactions involving XRP on the secondary market conducted by the company and its executives do not violate securities laws. Chamath also weighs in, emphasizing its significance for Ripple and the broader cryptocurrency industry. He believes that the ruling serves as a major obstacle in the SEC's case against Coinbase and other related crypto firms. The All In podcast also pushed back on former Treasury Secretary Larry Summers and challenged his views that interest rates will have to remain higher for longer than the market predicts, as countries decouple from China and their economy continues to fall. What do you think about the latest interview with Chamath? And do you believe this decision is a significant win for the crypto industry? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.